Hello and welcome to The Big Fight. We are here in the city of Mumbai, right next to the ocean. It's an absolutely fantastic place to be, and we have a really great audience with us right here in Mumbai. And we also have with us some of the top financial minds in the country. And we're all here to try and get you the answer to that one question that you're probably asking yourself. Where should I invest my money right now? Where should I park it? I'm hearing all these reports about the Indian economy collapsing and the global economy collapsing and what's going to happen to the rupee and blah and blah. Diwali is coming. Diwali is a very good time to really think about making some investments. So should it just be gold, or should it be equity? Or should I buy a house, or what do I do? Put it all under the mattress. So we've got experts in the field, and I can tell you these are the top experts. So you should listen to them, and they'll tell you what to do with your money. And we'll come back 1 year later and we'll see how we actually manage. Come back next Diwali. So it gives me great pleasure, and it's a privilege to have all of you with us. Ramdev Agarwal, Joint Managing Director, Motilal Oswal Financial Services, one of the top voices and the top thinkers in the Indian stock markets. What he doesn't know about the markets probably doesn't deserve to be mentioned. So it's great to have you with us. Niranjan Hirannandani, Managing Director of the Hirannandani Group, who can tell us whether real estate actually is still a good play or is it not. So you will be slightly biased, I guess, so we will discount that, but we'll ask you nevertheless. You are biased, right? Okay. Gold. Many people want to go into gold. So Chirag Mehta, Fund Manager Commodities at the Quantum Mutual Fund, and has been tracking gold very carefully. Still bullish, I hear. So we'll see whether gold is actually the place to be in or not. Professor Binu Paul, who's at the TIS School of Management and Labor Studies. It's great to have you with us. He doesn't have a high opinion of the stock market. Again, it's a privilege to have one of the top mutual fund managers in the country with us, Nimesh Shah, CEO and MD of the ICICI Prudential Mutual Funds. Many people say that retail investors should just go down the mutual fund route. So we'll ask you if you think that is the case, and if so, which mutual funds should they be going to? And just in case you didn't think we had enough real estate gunpowder, if you like, and getting another voice to talk about real estate and to push that, Abhinandan Lodha, Deputy Managing Director of the Lodha Group. Again, presumably slightly biased in favor of real estate?
And slightly more informed.
Okay, fantastic. So great to have you with us. And maybe somebody who can help us balance between the different views you're going to hear. Harsh Rungta, CEO of apnapaisa.com. Thank you all so much for being with us. Why don't I get opening thoughts from all of you, and then we can proceed and look at each individual category in some detail. Ramdev, why don't you kick off?
If you are looking for a return from this Diwali to next Diwali, that's about a year. I don't think this is the asset class to look at for 1 year kind of investing. I'm not saying that markets cannot move. But typically, if you're looking for equities, you should have a very patient money, which has to be 3 to 5 years kind of money. And if you are in a hurry to get the return, that's also not the right kind of characteristic for equities. So,
but if you have a longer time horizon, do you feel that equities is still good?
That's the only way to go. Because I can tell you this country is very inflationary. The biggest enemy of inflation, biggest enemy of investing is the inflation. Because investing means getting more purchasing power by surrendering current purchasing power. And that you can do it only if you can hollow the inflation. And inflation here is about 8 to 9% compounded. And I'm not talking about 2-3 years. I'm talking about 30-35 years of recorded history of 8.5% kind of inflation. So how do you beat them? The only way you can do it is if you go to either equities, real estate, or some farmland or something like that. But by going to the fixed income and gold, you barely cover the inflation. So you have to have some portion in equity or equity-like assets.
Okay, fair enough. Equity or equity-like assets. I mean, a lot of Indians would feel that historically one of the best ways to cover the risks that Ramdev was talking about is actually to go into real estate, and I want to get both you and Mr. Lodha in on this. Having said that, there are others who will feel that yes, real estate has been great, but our price is now a bit, overpriced. So, what do you think?
I think if you're looking at the next 1 year, or you're looking at the next 3 years, or you're looking at the next 10 years, or you're looking at the rest of your lifetime, you better buy real estate today. You're not going to be able to afford it tomorrow. So if you don't buy it today, you had it next Diwali, because the costs are going up, and every conceivable input of cost in terms of real estate is going up. In the last year, we have not had 8 and 9%, we've had 15 to 20% inflation. and that includes 7 to 8% government taxes have gone up.
Okay.
So it's not just going to go up, it's going to shoot up.
So if you want to get real estate, do it now before it's too late.
Before it's unaffordable.
It already is unaffordable if
But
you
it'll
ask
be
me.
more unaffordable.
Okay, before I come to the rest of it, let me just get your thoughts on it. Real estate, is this really the time to get in or wait for a correction? Don't you think a correction is coming at some point?
I think asset class which has a high beta is able to save itself from volatility as a natural hedge for inflation, along with the imminent demand-supply mismatch in India, especially in urban areas like Mumbai. Definitely make real estate a very, very good bet, both in the long term and the short term.
Okay, Dimesh?
Looking at the interest rates, that the level at which they are today, the 10-year yield been at the level at which it is, debt mutual funds are a very good option today. In my mind, if you are sticking strictly a 1-year view, I don't believe 1 year down the line interest rates will be as high as that. So people need to understand that if interest rates go down, then bond values goes up, and debt mutual funds make much more better return.